And then we've got an exciting guest for you tonight. Some of you may recognize the last name. Please don't hold that against him. But we're going to hear Charlie's story of 20,000 to 20 million. Okay? Everybody loves a good success story, and this was it's really inspired me. Then we're going to give you an update on Valley Center and a quick update on Oakview as well. Valley Center, as you know, is we'll get to that point, is the office building that we're buying, and we're also going to be a tenant. Darwin is going to be a tenant in that office building. And then, of course, Oakview is a little bit down the road. We close on that in June. But again, we'll just give you kind of a quick update for those of you who haven't seen it or heard about it before. We will have plenty of time for questions and answers, I promise you. And we're going to go through the meeting, and then at the end of the meeting, if you want to stick around, I would love, again, to meet every single one of you. But we'll be glad to answer any questions you might have and just network. Darwin Journal Real Estate is not new to this game. As you can see, from 1990 to 2001, these are just 23 of the properties, over 5,600 doors that Darwin owned and managed under Darcorp Management Group. So again, you can see, again, good information up here, all the way from Arizona through Texas, Washington, Arizona. So just to give you an idea, we're not new to the game, okay? In 2001, and I continue to brag about this, in 2001, Darwin and Darcorp Management Group managed a portfolio and sold that at the time for over $200 million. It's a huge story in the Dallas Morning News. Again, just want to give you the idea that we're not new to the game. Darcorp knows what they're doing. At that time, that was one of the biggest transactions happening in the Dallas-Fort Worth area, multifamily transactions. So, historical returns. Again, these are properties that have already, the only way I can give you historical returns is if they are completed. I can't give you historical return for a property that we still own because it's not through, right? So these are completed properties. Again, since the this is since the previous portfolio that was sold. Total of 2,189 doors. Average held, you can see anywhere from, some of them were 384 months, some of them 175 months, 197 months, but an average of 55 months was the holding period for the properties. $100,000 investor, what did they realize on these completed properties? $227,855 was their return if you were a $100,000 investor. So 136.2% total return, or 32.7 average annual rate of return. Okay? And again, this is just for the new people that are here, just kind of give you an idea of what it is we do. Again, we pool your resources, buy and manage these properties, hold for long-term cash flow, tax benefits, and then the proceeds at the end of things. What is the investment plan? As I just said, hold for long-term cash flow. And I'm not going to speak for Darwin, but Darwin would tell you, if we had our way, we would hold everything forever. Okay? We're not flippers, and that's really what I'm trying to get to. We're not people that are getting in 12 months down the road trying to get out. Okay? That's a risky game, but we hold for long-term cash flow. Maximize your tax benefits. Caveat: we do not give tax advice. Please talk to your CPA and/or your better half, whichever is more important to you at that point. But we do not give tax advice. We are not tax advisors. But there are multiple reasons why multifamily is good for tax benefits. And again, if you've got the brochure tonight, you'll see that as well. A lot of that's in there. We refinance for big returns. So it's not a lot of like you having a home and you refinance and pull cash out. Same thing here. After a certain amount of time we've operated the property, increase the value, then we refinance it, pull money out, give a good chunk back to the investors, continue to operate long-term cash flow. Old quality properties. If they're good properties, they're going to continue to increase in value, which is why we like long-term hold and not flipping. Protect the investment. Leverage the transaction so that you can withstand downturns in the economy. Structure it so that you are protecting the investment. And why is that so important, Anand? Because the next one, protect the investors. Okay? That's you. Each of you, most of you here are investors, and I hope by the end of this year, every single one of you are investors with us. And then, of course, adjust for the market conditions. As things progress in the market situation changes, As a team, we're always looking at that and seeing what is the best thing to do. Is it refi? Is it sell? Is it hold? Again, you have to adjust for market conditions, which is why it's really, really important to have an experienced team behind you who has been through this on multiple occasions. Okay, real quickly, I'm going to introduce the team. Darwin's going to be up here in a little bit, and most of you know Darwin, so I'm going to skip him really quick. But I do want to recognize his better half. Kelly, I know you're here somewhere. She may be out at the table. Anyway, Kelly's here tonight. She was manning the table. There she is. There she is. She's here tonight. Julian is standing here next to Darwin. Julian is our, let's say, Director of Property Acquisitions. That's a good title, right? He helps us underwrite. He's looking at, I don't know, 2, 3, 4 properties every single day, maybe even more on some days, dozens in a month, to look at those properties and evaluate them to see if they meet the criteria that we need to buy those properties. Jeff Younglove, raise your hand please, Jeff. Jeff is part of the team as well, and again, as you've heard before, Jeff just kind of does a little bit of everything. He helps where help is needed. Kai over here to the right, and then we've got Mo here manning the camera, which he typically makes us look better than we really do. Is our marketing team and our IT team. So again, thanks for being here. Reggie, I see you back there. Reggie, and for those of you who are interested in getting into a property and think that you may want to take that step, Reggie has his hand up. Anand, would you raise your hand, please? These two guys went through the co-sponsor program with DGRE, which means that DGRE, as a team, with their help, went and found properties for them to purchase. They now are part owners of those properties and are the asset managers of those properties. It basically gives them the opportunity to learn the entire process from start to finish. So if you're interested in that, I'd really encourage you to talk to Anand and Reggie, and you'll get some good information. You see, Vicky, would you raise your hand? Vicky back in the back is our Director of Property Management. So our properties are managed in-house by Darkport Management Group, and that's really Vicky's responsibility to manage all those properties accordingly. We're thrilled to have her on board. And I know I'm going to miss somebody, but I'm looking to see if I haven't missed anybody. I don't think so. David Tuttle's I'm looking for, but David has the flu tonight. David cannot be here. Hey David, can you see the video? So I asked him not to come. We did not need anybody to get infected. So David is our investor relations guy.
He's good.
So if you wanted to become an investor, that's probably who you're going to be talking to. Okay? So again, Darwin himself has over 30 years of experience in the business. Collectively, the team has somewhere between 150 and 200 years experience in the business. So I stress that because we're talking about the experience that you want to have behind you. But the most important thing to us is the experience to the table and operates under the DGRE culture of best interest of the partner. That's you. Every decision that we make is what's in the best interest of the partner, because if you're not there, we're not. Okay, announcements and updates. I only have one announcement / update for you tonight, but it's a good one. How many of you are in Gold Creek? Great news. Great news. We're closing next week. Okay? As you know, it was one that was planned to close in 2019, and due to some planning and zoning issues with the city that had to get straightened out before we could proceed, it carried over through the new year, but now everything's been taken care of, and good news. And one more piece of good news about Gold Creek. Not only closing next week, there might be, I think there is, one spot for a lucky investor. I think a $50,000 spot is still available for investors. So if anybody is interested in getting in Gold Creek and you didn't get a chance to do that, please call David Tuttle, reach out to David Tuttle. If you want to talk to me tonight about it, that's fine too. But that's going to close next week. We're super excited about taking over for that property. It'll be really the first Class A property in the portfolio, but we're really excited about it. It's a great property, 2017 build. We're thrilled about bringing it on board. Without any further ado, I'm going to ask Darwin to come and introduce our guest speaker tonight. Thank you.
All right, I am excited because my brother, Charles German, he's 3 years younger, just so that you know. And just to add a little bit more to the equation, I've said this before, he's got the Midas touch, and it always pissed me off on how good he always did on everything he did. But it's not just because of luck or anything else. He works hard and he's smart. Now, he doesn't syndicate any deals. So please welcome my brother, Charles.
I'll stumble through this, hopefully get better as I go along. This whole thing came about because Darwin and I were talking last year, and I started looking back at my history, and I started investing in 1998 in real estate. And it was 2018 at the time, and I was thinking, gosh, I remember starting with $20,000 I had saved. And at the time, the portfolio was about $20 million. So I said, wow, it's 2018, I started in 98, started with 20 grand, now the portfolio's worth 20 million. It's 2020, 2020, I thought that was interesting, and so did he, so he said you should come speak. So here I am. I live in Dana Point, California, which is Southern California, about 50 miles south of Los Angeles. I have my wife and 14-year-old son, 12-year-old daughter. And not sure how much you get out of this presentation. Darwin just said, get up here and tell you my story. So here's my story and some lessons that I've learned along the way. I'm going to couch it as what I'm teaching my kids about money, because this will kind of go hand in hand and exactly what I'm teaching my kids about money. My son is 14. He's in the business program at high school. So this is what I got. I wasn't a big fan of high school, so I took my GED and went to college, and then I wasn't a big fan of college. So I had an opportunity to move to Chicago to trade on the floor of the Chicago Board of Trade, which is super cool. I had a blast. And let's see if we got the slide. There it is. So this is the Chicago Board of Trade. I traded the 10-year Treasury notes. These are financial futures. And this is where I lived for 5 years, right there in that front pit. I know all those guys. That's the 10-year Treasury note pit. That's the 5-year Treasury note pit. In the back is the bond pit. On the side of the options pits. And along here are all the investment bankers. So what happened is you would call the floor of the exchange. Somebody over here would pick up the phone. Then they'd hand signal in an order to, buy $1 million in Treasury notes. And they'd call in the order, hand signal it in to the guy on the outside. He would tell it to the broker. The broker would turn around, yell, trade it with another guy, and then it would go back in reverse. And this way of trading has been around since 1854, so it was 150 years old. But it was a lot of fun. I was in my early 20s, and had a good time. I didn't make a ton of money, but I saved $20,000 to start investing in real estate, so that's good. In 1998, the exchange took trading to the internet. So I kind of saw the writing on the wall. The exchange floor was going to go away. Everything was going to be on the internet. So I decided to move back to California to be with my family and start investing in real estate. And sure enough, 10 years later, that's what the floor looked like. And it doesn't even exist now. It's gone. So that was my segue into real estate in California. Now, as I mentioned before, I'm going to kind of couch this as what I'm teaching my kids about money because it's pretty simple stuff. So we'll start here. Why can't I get the hang of this? So what I'm teaching my kids about money. So I remember when I was 21 years old, Darwin actually gave me this book, Rich Dad, Poor Dad. And I read it and it resonated with me because it's kind of what I've been learning from my grandpa and my dad before Darwin even gave me the book, which is own your own business, invest in real estate, passive investments, multiple streams of income, that type of thing. And The Millionaire Next Door also was something that resonated with me because The Millionaire Next Door is basically my father-in-law. He worked for CBS. He never made a lot of money. He used to have yard sales. He had vending machines. He did whatever he could, and he ended up with 4 houses paid for. He wanted 5 because he had 5 girls. He wanted to give everybody a house. He ended up with 4, but he was the millionaire next door. His houses were worth $2 million, but he never made a lot of money. And that whole story is about basically living below your means, not being flashy, don't spend a lot of money. So these are the two books. My son actually has Rich Dad Poor Dad on his desk right now, and he's 14. So live below your means, invest early, invest often. That saved me. I started when I was 25 in 1998. And if I hadn't started investing early, I could never be where I am now. And so that's what I'm just going to pound into my kids. Do whatever you want, be whatever you want, make whatever money, follow your passion, but invest early, invest often, and live below your means. Multiple streams of income helps, and always try and mitigate your tax exposure, because in California you have to give half of your income to the government. Here it's a little easier, a little better, but still, if you have to take a big chunk out and give it to the government, it's hard to compound your money if you go like this, the whole way through. So this is basically my financial literacy. And it's good. It's a good foundation today, I think. So when I look for a property, I've always kind of did the ready, fire, aim, which I don't overanalyze it. I don't want to go through analysis paralysis, and if you do that in this day and age, you're going to lose the property to somebody else anyway. So ready, fire, aim was kind of my MO. I like the Wayne Gretzky, you'll miss 100% of the shots you don't take. So I would just fire, I would buy it, and I would try and buy stuff that had kind of a risk-reward ratio in this zone. You're risking a little bit to make a lot. That's kind of how I looked at it. The dumpier the property, the better, because then it doesn't have far to fall. If the previous owner has run it into the ground, perfect. It only goes up from there. So this is kind of the risk-reward profile. Look on the acquisition. It's exactly the opposite on the disposition, but on the acquisition, give me something where I could look at it and say, if I did just this or that, I won't lose any money. But if I did this and that, I will make a lot of money. So that's kind of how I have done it. So there's a few basic lessons. Lesson number one, the property has to cash flow. I don't have enough money to write checks every month for an investment. That's not considered an investment. In fact, Richard Kiyosaki, Rich Dad, Poor Dad, he says it pretty plainly. Assets put money in your pocket, liabilities take money out of your pocket. Make sure you're buying an asset. And something else that's interesting that he says is most people think their home is their biggest investment, their biggest asset. He says your home is your biggest liability because it costs money and takes money out of your pocket by his definition, and I agree with him. I like living in a nice house, everybody does, I like shelter, but it takes money out of your pocket that you could be investing elsewhere. So if it doesn't cash flow, at first you go bankrupt slowly, then all at once. Lesson number two, add value. That's why I like to find the dumpiest property. I know I could fix it up. I look at it, first thing I do when I see a property is, I do this, that, and the other. Easy. So every day I get up looking at my real estate portfolio now, and I say, what can I do to make it better? Can I raise rents a little bit? Can I, separately meter it for electricity? Can I, put on a tool belt and save myself some money by, doing some repairs? So every morning I get up with my mindset on improving something. And I know Darwin does too, and pretty much anybody who is into real estate investing should be thinking that way. Lesson number three, sometimes you just have to make it happen. A couple of properties I'll show you. If I didn't make it happen, I'd be broke. If you buy the wrong property and you don't make it happen, it can ruin you. So you have to make it happen. And I like nothing will work unless you do. As passive investors, luckily you have somebody that'll make it happen. But for me, it's all me. If I don't make it happen, that's on me. So make it happen. Make it work for you. So the risk-reward profile changes after you've kind of got your building 90% there, let's say. So it's the same colors, but you can see the risk is bigger and the reward is smaller. And what happens is, like here, I bought an office building in Euless and Richland Hills and DeSoto, and they were 30–40% vacant. And that's a good risk-reward profile. You know, it's not going to go too much farther down, but if you fill it up, you can make a lot of money. Once it's full, that's where all your risk is, because once it's full, there's no more upside. Any additional income you're going to get is going to be incremental. So your upside is limited, but your downside's huge if you have some big tenants that are going to move out. So on a hotel, same thing. I did a hotel. And pretty much anything I do, when the upside's gone, I just see a bunch of risk, and that's when I sell it. So sell when the risk-reward profile shifts against you. You don't want to hold on to that, because then you have to do it all again. When people move out, then you have to do it all again. Lesson number 5, mitigate taxes. And I wrote 1031 really big because this is basically saved me. 1031 exchange, it saved me from spending the money I make. It saved me from paying taxes. I feel like everything I have is because of the 1031 exchange. Otherwise, I would have spent it, my wife would have spent it, we would have gone on vacations. But in a 1031 exchange, you have to reinvest your money following a certain set of rules in a certain time frame, otherwise you pay tax. So it forced me to save the money, forced me to buy another property. That's the other thing. You have to buy another property, so you're gonna do it. You're gonna make it happen. You're gonna have to buy another property. Otherwise you pay taxes. So that's rule number 5, and I feel like I owe everything I have to this section of the Internal Revenue Code, which is strange to say. So I'm just going to go through a few investments that I've done, some that I think we could learn something from maybe, some that are just interesting, and some that just kind of tell my story a little bit. This was my first investment, 1998, Diamond Bar, California, which is just outside of Los Angeles. Like I said, I started with $20,000. I bought a condo for $88,000. I knew I could rent it out for $1,000 a month, so check the box, cash flow. And my idea at the time was just get the property, get in the game, get an investment, make sure it cash flows, and we'll see what happens. So I had it, I rented it out for a year, bought my second one in 1999, again around $90,000. Same thing, just needed a cash flow, just needed it there. Get in the game, invest that second $10,000, and a year later I sold it, and I sold the other one as well, which I held this one for 2 years, sold it for $110,000, had a profit of $22,000, but I only put $10,000 down, so it's a 220% return, but over 2 years my annual return is 110%. So 110% is a pretty good return. And this one, same thing, annual return is 170% because I only held this one for a year. So I sold these 2 condos and I bought a house in 2000. West Covina, again, this is just where we grew up. So I knew the neighborhood. And this one I actually added some value, did the landscaping, did some paint, redid the floors, some minor cosmetic value add type of stuff. I paid $205 and sold it for $340, put 25 grand into it and 60 grand down. So my profit was 110,000, so I made 86% return on investment. The other thing I think to note is there are 3 ways to make money in real estate. There's when you buy it, you get a good deal. So you always try and get a good deal, you negotiate. You add value, that's another way to make money. And then the third way is a little less quantifiable, but I'd say the disposition would be the market. The market can help you with interest rates. Maybe you find a 1031 buyer. So that's the third way you can make money is just by finding that right buyer at being the right time. So that was the third property I bought. And don't worry, I'm not going to go through 20 properties like this. So this is I'm skipping ahead. This is investment number 8, 2003, Duluth, California, which is North San Diego County, South Riverside County, Southern California. And I always heard that buying property in the path of progress was a good idea. You could get some exponential growth, but I can't buy land because it doesn't cash flow. So I looked in this area, scouted this out as a potential real estate custom home site, found out that avocados actually pay money. So this was 50 acres of avocados and lemon trees, and went through the process with the grove managers and the farm managers and determined that it really does cash flow. This grove in particular had about $70,000 in fruit hanging on the trees when I bought it. I bought it right before harvest, so I could pick the avocados, take the 70 grand, and redevelop the rest of it, the other 10 acres that wasn't developed. And so the way I added value with this was I redeveloped the 10 acres, so it's all fully developed. I put a nice road up to a potential home site so a buyer could see, oh, this is beautiful, I can build a custom home in the middle of a grove in this beautiful area. I put a really beautiful gate and big stone sign out in front. And so I added some value, kind of made it pretty, redeveloped it, redeveloped the vacant land so that any buyer could see that there's more cash flow down the road. And I made a 68% return on a piece of land with some trees on it. So that was pretty good, I thought. This one's here in DeSoto, and this one I owe to Darwin. I sold a property in California, and I had money in this 1031 exchange. And Darwin had this one tied up. He had it tied up for $2 million. And it was 30 or 40% vacant, which had that risk-reward profile I was looking for. Fill it up, sell it, make some money. But Darwin had it in escrow. So I said, hey, Dar, I need a property. He's probably cringing right now. I said, I'll give you $100,000 for your contract. And so he said, okay, I'll take it. So $100,000, easy money, which is a lesson in contract assignment. When you write a contract, you should say, your name as the buyer and or assignee. So if somebody comes along like me and says, hey, I want to buy your contract, you can just assign it over and pocket the money. So that's what Darwin did, pocketed the $100,000. I worked with my property manager and leasing agent. We got it filled up, and I sold it when it was full, and sold it for $4 million. So that was a good hit. The profits are starting to get bigger. Not paying any tax on them, and so I made a 63% return on that one, which was great. Jumping all the way ahead to investment 16, I took that $4 million from the DeSoto property. I bought this office building, and this is interesting because I bought it in 2008. You guys remember what happened, remember the Great Recession. So I bought it in 2008. Luckily, it was a medical building. And luckily, there were long-term leases. It cash flowed, so it held up during the Great Recession. Again, had about 25-30% vacancy, and during this time, the tenants would one by one kind of move out, and this is kind of my lesson in make it happen. My first big lesson in make it happen. And my leasing agent wasn't doing anything about it. I'm getting no calls, there are no new leases, people are moving out. The value of the building is going down because people are moving out and my cash flow is decreasing. So I said, hey, what's going on with this, what's going on with this property? And the leasing agent said, oh, it's slow. Meanwhile, he had taken over a 10,000-foot vacant building a block away, and he filled that up. He leased that entire building up, and I didn't get one phone call, and my building was way nicer. And so I said, that's it. I gotta figure this out. You're fired. Hired another leasing agent. Same thing, 6, 7, 8 months, and he just He just kept saying it's slow. So I said, I got to make this happen because this building is just decreasing in value every month. So I fired him. I said, I live in California. I said, I'm going to put my own sign out there and I'm going to see what's happening. Are people calling? And we're just not closing the deal. Are people not calling? Is my price too high? What's the deal? What's going on here? So put my sign out in front and still not getting many calls. So I went to every office building in a 10-mile radius and I took a picture of their directory, where it says everybody that's, I think Facebook advertising probably in this day and age would be way easier, but I took a picture of every directory in every office building in a 10-mile radius, took it home, built a spreadsheet with all the data, built my own mailing list basically, and produced a mailer, started mailing it out. Within 6 months, I had the place fully leased and within 6 months for $5,450,000. So that was my huge lesson in make it happen. Whatever my leasing agents were doing, they weren't doing it for me. They were doing it for somebody else. So it gave me a lot of confidence, and it taught me that you can do it. You just got to go make it happen. So this, it goes against that asset liability, don't spend money on a house, negative cash flow rule. But I love Lake Tahoe. It's this is in Incline Village, Nevada, actually. And I bought this house because it's been my dream to live there. It's beautiful. And I was hoping to coerce my wife and kids to move up there permanently. So I bought this house, and it's just a basic plywood house, very cheaply built, but it was a block from the lake. And if anybody knows anything about Incline Village, it's the street a block from this is called Billionaires Row. So there's Michael Milken, Larry Ellison, David Duffield, all these billionaires own these compounds on the lake there. It's really prestigious, super nice. It's Nevada, so it's a tax haven. So there are a lot of reasons to buy this house. So I bought it thinking I would, fix it up, maybe talk my wife into moving up there. And so I paid $850, and I rebuilt it and doubled the size of it, put a down payment, and I sold it for $2.625 a couple of years, 4 years later. So I made money on it, even though it was not a cash flowing property. But that's another add value lesson. Here's some pictures. Here's the plywood house. It just started building there. A little more building. Almost done. So it was great. It was super fun. We actually did move there for a year. That was the year they got 60 feet of snow. It was a record year. So my wife said, we're out of here. I tried, almost got it there, but it didn't work. Investment number 20. So Lake Tahoe, we've been going there our whole life, our family, since we were kids. So when I sold that medical office building I just showed you, I said, I want to travel somewhere fun. Instead of flying to Texas, maybe I could fly to Lake Tahoe to work. And so I started looking up there, and I found this hotel. And funny story about this hotel, it looks nice in that picture. When I bought it, it was called the Fantasy Inn. And the Fantasy Inn was a themed hotel, romantic hotel.
Mirrors on the ceiling type of.
Yeah, they did 300 weddings a year there, and it was like every room was different. Mirrors on the ceilings, jacuzzi, heart-shaped jacuzzi tubs. And in 1998, this was the most successful hotel in South Lake Tahoe. But imagine that type of hotel 13 years later with not a penny reinvested into it. Same carpet, same beds, same jacuzzi tubs. It's pretty disgusting. So that's one of those examples of it can't get much worse. Perfect, I'll take it. So I bought this hotel, and it was a nightmare. It was a total nightmare. I hired a management company because I know nothing about the hotel business. So I hired a hotel management company, and they just kept calling me every month, like, hey, send another 20,000, send 50,000, send 30,000. And it kept going on like that. And I said, well, what's going on? What's our game plan? How are you setting the rates? What are the occupancy levels? And they would just kind of say, I don't know, we're flying by the seat of our pants. This was a property, got bought out of bankruptcy. We're just winging it. And obviously that didn't work for me. So, and this is a big investment. And if I keep sending a check for $50,000 a month, how long is that going to last? So I looked around for other property management companies, hotel management companies, couldn't find any. So finally, unfortunately, I bit the bullet and said, all right, you're fired. Fire the management company. And now I live 500 miles away. I have a hotel that's failing. No hotel experience. It's mid-renovation. Half the rooms are shut down and gutted. So I just had to make it happen. So I hired 20 employees, got a new contractor, started learning the hotel management business, and started commuting from Southern California to Lake Tahoe, 500 miles away every week. And it was extremely painful. It was very hard on our family, and it was very stressful. Probably took some years off my life, but figured it out, built my revenue management systems, built my hotel management systems, got some solid employees, and we went from $500,000 in revenue the first year I bought it, to $1 million the second year, to $1.5 million the third year, to $2 million the fourth year. And that's when I said, okay, my risk reward profile has just shifted. We're at 88% occupancy, which doesn't get much higher in a hotel business, especially in a resort town. So that's when I said, okay, it's time to sell this. Risk reward profile shifted. If we get a recession, this thing's gonna go right back down. So I paid $3,850,000, sold it for $9 million, which was huge. That's the grand finale. And that's when I started reflecting on, okay, that's 20 properties. Oh, and it's been 20 years. And so it's all interesting and really cool coincidence. But that was kind of my big grand finale, was this hotel. I actually ended up selling this and buying 7 apartment properties in Lake Tahoe, packaged those up. Those are now for sale. So I'm just keep going, but that's the end of my 20 years, 20 properties run. So I put some pictures up here. There's the safari room. Notice the TV over the bed, the leopard skin carpet. There's a big jacuzzi tub here. That's when it was new. Imagine it 15 years later with the same carpet. There's the Alibaba room. See the mirror on the ceiling? Drapes, leopard skin carpet. Just disgusting. I just had to burn everything. And this is what I turned it into. So the Alibaba room turned into the King Spa Suite. Did some, made it look like a mountain hotel, and turned out nice. Oh, there's the lobby. Used to have purple carpet and laminated. Those pictures up there, like backlit pictures of their suites, and they had a sign on the wall that said "World's largest collection of romantic artwork." It's pretty funny, fake plants. So I turned it into a normal mountain-style boutique hotel. This is the last part of it, and I feel like I can't do an investment presentation. I've never done one before, but without mentioning compound interest. Compound interest is what the 1031 with compound interest is what grew my portfolio. And when I was trading futures and building trading systems, same thing. The compound interest is it's astronomical. So in my son's business class, this is one of the first things they teach him. So you can see simple interest is just you make your 10% a year every year with the same starting balance. 50% APR, which is average percentage rate, which is not compounded, times 20 years, you'll have 1.1 million. If you make 50% a year on 100 grand over 20 years, but you don't compound it, you just put it in your pocket, stick it under your mattress or whatever. Compound interest, let's say you have the same 100,000, the same 50%, but it's APY, average percentage yield, which is compound interest, times 20 years. Any guesses on what the same 100 grand, 50%. But if you compound it, any guesses? How many? 100 grand? 100 million? 50 million? 332 million. Do it on a spreadsheet, it's true. $100,000, and that's with not paying taxes, and that's with making 50% every single year. That's Warren Buffett's deal. You buy and you hold, you never sell. If you never sell, you never pay taxes, and you reinvest all your money back into it. That's Warren Buffett's the billionaire next door. And I love his, I love the way he does it. Buy a company, buy it forever. Buy properties, buy them forever. And with your dividend checks, I encourage you to reinvest them so you get that compound interest. But it's pretty powerful. Being a family affair, I can't end it without putting a picture of Darwin up there. There's your fearless leader. This karate moves. But that's all I got. Thank you.
You were reinvesting all that in. How did you make a living during those 20 years and actually pay bills?
I cashed a lot of it in, which is why I don't have 332 million. So I spent some of it, so sometimes you take a few $100,000 out when you sell a property, and I also did some brokerage and some property management, and I made some money trading. So just cobbled together a living. But that's why I say owe everything to the 1031 exchange and compound interest, because without that, I'd just be trying to scratch out a living just like everybody else.
You said something interesting also as far as not being able to spend the money. I made $1 million on a building quite a while ago. And I sold it, and I took that $1 million out, and it's gone. I invested in some places that I shouldn't have. I spent it. I did all sorts of things, and literally, it's in his example. It is tied up. You can't spend it. And one of the things our dad taught us was never, ever, ever spend your investment capital, because you'll just blow it. So you got to keep it going. Any questions out there?
I got one question. Do you have any regrets on not keeping a certain property longer than when you sold it?
No, because when I'd sell a property, I feel like it had run its course, and it kind of, I squeezed 90% of the money out of it, and then I took it and went to another value-added property. So if I would have just kept it, it would have just been kind of floating along like this, where if you sell it and you take that money and then you add a bunch of value, and then you sell it and add a bunch of value, that's the way I've had to do it, because I don't have investors. I just do it myself. If I had an endless stream of money, then yeah, buying and holding and just keep going that way. But I had to take the money out in order to find another value add deal. When I bought the hotel, I was like, I'm never doing another 1031 exchange, because finding that deal was hard enough. But you change your mind. But it's hard, but it's doable, and you don't always find a good deal. Just find something that you think you can make something out of. Worst case scenario, just that you don't lose your money, because then you could sell it and find something else.
Something else interesting? What's in your current portfolio?
Right now, I own 7 small apartment buildings, a couple of houses. So I sold the hotel, and I bought 7 small apartment buildings in Lake Tahoe because there's a housing shortage. I have $9.2 million into them, and I put them on the market this week for 13.4. So I took these small properties, which were awful properties, fixed them up, raised the rents by 50%, bundled them into a portfolio, and that's what I'm in right now. And I'm in the process of trying to sell that and looking at some of Darwin's deals, looking at building something. Like, I don't know what I'm going to do next, which is, the 1031's hard, it's stressful, but you just got to put your feelers out there.
If you have troubles on a 1031, what's the worst that can happen?
Well, you pay 20% in long-term capital gains, plus I live in California, so there's another 12 something, plus there's I think a 3.5% Obama something or other. It's like 35% for me living in California.
Now, and it gets worse because it goes from his basis all the way to what he sold. And his basis started, do you know what your basis is on all these properties?
It's about 3 million. It's
About
low.
3 million. So he's paying, if he sells that at 12, he's paying 35% on $9 million. So that's his downside. That's why 1031 buyers are so good for us here, is they have to buy, period. Otherwise they're getting toasted on taxes.
Darwin German Real Estate is proud to present its next great investment and the future home of Darwin German Real Estate Investments corporate headquarters and education center. The Valley Center office building presents Darwin German investors with a unique opportunity to acquire a stabilized, well-located office property in the heart of the Dallas-Fort Worth Metroplex. Just east of the DFW International Airport, Valley Center is located in the middle of the Valley Ranch submarket and is adjacent to the popular Las Colinas submarket. Just north of Interstate 635 and west of the George Bush Turnpike, the 3-story brick veneer office property was constructed in 1986, has ample parking, and boasts an impressive lobby with a 3-story vaulted ceiling. The 77,000 square foot building is currently 86% occupied by 45 diverse tenants. In addition, Valley Center has 22 executive suites, which command higher rental rates than a standard office suite. Valley Center has significant occupancy upside, with additional opportunity to increase rental rates, as current rental rates are well below the rates of competitive office properties in the submarket. The Valley Center office property is located in a heavily populated residential and retail corridor with easy access from several major highways. It's minutes away from DFW International Airport and is accessible from both downtown Dallas and downtown Fort Worth. The Dallas-Fort Worth market continues to experience stable and growing office occupancy, along with consistent growth in rental rates. The projected population growth within 3 miles of the property is expected to grow by 5.54% over the next 5 years. Valley Center is uniquely positioned to service tenants who live in the immediate area, and there are no competitive properties within 1 mile. The Valley Ranch and Las Colinas submarkets are home to a diverse mix of local, regional, and national companies, and has consistently attracted businesses that want to locate in the area because of its central location in the DFW Metroplex. Valley Center is a well-maintained property with limited deferred maintenance. Darwin German Real Estate will invest targeted capital improvements to elevate the quality of the interior and exterior common areas, creating a stunning corporate headquarters. In addition, we plan on building a state-of-the-art education and meeting facility as we continue to provide our partners with ongoing real estate investment education. We are excited to add the Valley Center office property to the DGRE portfolio and excited to make this opportunity available to the family of DGRE investors. Please reach out to the Darwin German Real Estate team to discuss this opportunity.
So like you heard in the last meeting, we put it under contract. We found some things that were going to cost us extra money. We renegotiated it, came back, and got $350,000 from the seller to kick in to go ahead and do improvements. So we put that back under contract. It's back under contract and looking at closing by the end of next month. And it's like Charlie's office buildings, it's 88%. There's a few people that are moving out, which is also why we got a little bit of concession. The rents are low, and did you love the mauve colored tile? Very 80s. So you update the whole thing, and you already have lower rents than the market. So we're going in there, update the whole thing, just like apartments. You go in there, you make a nicer product, you raise the rents, and add value that way. It's exactly the same type of economics as apartments. So, and we already had a bunch of commitments on this, so the PPM is now available on IMS. Who's on IMS? Okay, it's available on there. Accredited investors only. So when you go on IMS, they will go through a third-party accreditation process to go ahead and say that you're accredited. And other than that, we're going to fill up real quick on this deal. And again, the part that we like the best, part of the reason for this is we have brought all the management in-house. Again, mirroring what Charlie did, make it happen. And third-party management companies suck, as he explained in his examples. So we had to bring that in-house so we have better control and better performance for the properties, which goes to what Brian has said, it's always doing what's best for you guys. And in there, we're gonna go ahead and put a training center in there, video those, and do weekly training classes on different things, whatever subject you may want. So if there's any subjects you wanna learn about on that, you want to have a 1031 guy come in and talk, we'll do that. You want to have property management, do that. You want to understand how to read the financials, we'll do that. Whatever it is, and we'll have smaller groups, but more opportunities for you to do that. So we don't have to rent space. Quick sidebar, a good reason we don't rent space now is Noah's Event Center, the place we were going to have it, just shut their doors because bankruptcy court ordered it closed. So luckily we were not there tonight. So, Valley Center is the next one we have. We close on Gold Creek next week. Like we said, we only have about 50,000 left on that one. Valley Center, which is very conservative numbers. I think you've seen those. We're gonna have to do another webinar based on the new numbers after we've renegotiated this and finished everything, but we will do that within the next week. And other than that, we're good. What else is on our agenda here? What's next?
Darwin German Real Estate is proud to present its next great investment. Oakview Apartments provides DGRE investors with a rare opportunity to acquire a 2-year young Class A asset at a DFW Class B price and significantly below replacement cost, just west of Fort Worth, Texas, and just off the highly traveled 820. This gorgeous 3-story masonry and stucco property consists of 270 units built in 2018. Oakview amenities include gated access, covered carports, entertainment and media lounge, leasing office complete with business center, fitness center, a dog park, community center with outdoor grilling stations, and a spectacular luxury pool. Oakview still has rental upside as it remains behind other competitors in the area. Oakview has 2 1-bedroom, 1-bath floor plans that average just under 700 square feet and 2 2-bedroom, 2-bath floor plans that average just under 1,100 square feet. All units include 9-foot ceilings, granite countertops, tile backsplashes, full-size washer dryer, stainless steel appliances, walk-in closets, ceiling fans, Wi-Fi, and come cable ready. Oakview sits just south of Lake Worth and is within minutes of schools, shopping, restaurants, city services, and parks and entertainment options. The Dallas-Fort Worth market continues to be a top national leader for job production. The area supports over 3.5 million workers. Future job growth in white settlement over the next 10 years is estimated to be 40%, which is higher than U.S. average of 33.5%. The projected population growth within 3 miles of the property is expected to grow by 9.2% over the next 5 years. We are excited about adding Oakview to the DGRE portfolio and excited about making this available to the family of DGRE investors. Please reach out to the Darwin German Real Estate team to discuss this exciting opportunity.
Okay, and Oakview, same builder as Gold Creek, right up the street from Gold Creek. Same price, same economics, same everything, same clubhouse, same finishes, same everything, but it was built in 2018 instead. And that one is virtually the same numbers as Gold Creek. And so we're excited to go ahead and get that one and have a 2018 product so we don't have the risk, that risk profile Charlie talked about, which is the same reason we've sold a lot of the older properties, Tribeca, Las Lomas, Hazelwood. The risk turned against us, so we sell. Same type of lesson that's involved there. But now in these 2017, 2018 properties, which we're buying in the $135,000 a door range, which is well below replacement cost. And we even have B quality and even C quality properties going for that amount right now. So this is both of them I think are spectacular investments, and look forward to having you in those.